Well, Debashish Duttagupta is head of investments for Citigroup Wealth Management business in the Asia Pacific. He's with me now. Well, it's quite something, isn't this, Debashish? Overall, how do you actually make a calculation like this?
The way we look at calculations is obviously through public sources of wealth. So we look at sources of wealth. The primary source of wealth for most of our wealthy individuals is still the companies they have ownership stakes in. And then we look at other sources of wealth, such as property and financial assets. But you do start with their ownership in public listed companies. The other way of estimating wealth is through dividend income. So we look at people who receive significant chunks of dividend income and then extrapolate that to arrive at estimates of their current wealth.
Okay, well, that brings you on nicely to talk about this. It represents a shift here, of wealth from the West to the East, if you would like. But still, we have to put it into context, don't we? Because if we have a look at, as a percentage of the populations, it's still lagging. Yes,
absolutely. In fact, a lot of these wealthy individuals exist in countries where the wealth disparity is very large. If you look at the number of billionaires or millionaires, for example, in countries like India and China, it's extremely large as an absolute number. But then when you look at the number of people who are extremely poor, that's an extremely large number. So the wealth gap still exists. So as a percentage of the population, it's still a very, very small fraction, which is why Asia is likely to remain one of the strongest growing wealth regions in the world for some time to come. So this is not just a result of the temporary decline in the West because of the crisis we are seeing there, but a more sustainable trend.
Well, you did this report, I believe, with the help of Knight Frank, which is a property company. It's a wealth report 2012. Now, we can have a look at it. This is just the front cover, and I can tell you that it's very wide-ranging, and the corollary of this is also the shift in power from the West to the East as well. And so you make projections as to who's going to be the most important, which are going to be the most important cities in the world, the spheres of influence, etc., etc. And how does that all shape up as well?
Clearly, the concept of the Western economy is going to grow more slowly in the near future, and being outpaced by the emerging market economies, particularly the ASEAN and Asian economies, is something that is well understood. It's a kind of a consensus call out there. I think more importantly, what we've seen recently over the post-crisis has been a pronounced shift in absolute wealth of people bringing wealth home. If you're an Asian, bringing it home. So the home bias, if anything, has increased significantly. And the second sort of significant trend we have seen has been that a lot of wealthy families, a lot of globally wealthy families who used to erstwhile look at Switzerland, for example, as a destination where they would keep their private wealth or manage their private wealth out of, are now beginning to look at Asia with that in mind. So several cities in Asia are now beginning to become private banking centers in their own right.
These are ultra-high net worth individuals we're talking about. So how do they tailor their portfolios? I had a guest from the family office is just suggesting that a lot of them are really looking at cash right now, particularly in Australia, given the yield advantage, of course.
Yeah. If you look at our report, or if you go through it, you'll see that when we interviewed or polled some of these people, their cash preference is close to 19%. Right, which is a very significant number. Almost $1 in 5 is being kept in cash. And that is, I think, a reflection of the current market uncertainty they face in terms of the general belief that while we have seen a recovery from the absolute bottom, markets are still going to be in broad ranges for some time to come. And the recovery in the West, as and when it happens, will be very, very slow and extended.
Okay, but that again brings me on to what else do they invest in? What is the rest of the portfolio looking at? What are we looking at in terms of, let's say, alternative investments? What are you seeing which is different from, let's say, a year ago, or maybe 2 years ago even?
I think one sort of interesting learning experience for me personally and for our bank and for the industry in general has been how much some of these investors are investing for the long term through alternative means. So aside from real estate and art and hard assets of that nature, a lot of them are putting their investments in two broad buckets, so barbelling it, so to speak. So one is in the short term in cash and liquid instruments, and the other is in some of these long-term vehicles or long-term investments that will pay off in 6, 7, 10 years.
Diversification almost, isn't it?
Yeah, absolutely. And I think the reason they're doing the second, which is that investing for the real long term, 5+ years, and giving up liquidity, is that they feel that some of the asset valuations in the West at this point, from a longer-term point of view, are pretty compelling.
Is that the difference we're seeing between the 2011 and 2012 report, in essence?
Yes, I think the other difference we're seeing also is that the preference for equity has declined markedly between the 2011 and 2012 report. And in 2011, obviously, people had expectations for a bullish 2011. I think one of the things that people came into 2012 with was very, very low expectations.
Well, I mean, they would have been an absolutely, well, they would have loved it if they'd actually been in equities at the start of this year.
Absolutely, and that's normally when markets rally, when people think they can't, they can only go lower.
What about the perception of risk? Now, tell me about that. I mean, because people have been really just been thrown all over the place with what the markets have been doing in the last 2-3 years.
I think, firstly, there's a heightened sense of perception of counterparty risk in terms of who are the banks you deal with, are they sound banks, and so on and so forth. Secondly, I think erstwhile they would never think that a sovereign in the Western world could get downgraded, let alone default, right? They were considered sacrosanct, and that was a risk you normally associated with emerging market countries. I think that has completely changed. So I think the perception now is that and that's another reason feeding the home bias, is that within your country, so if you're an Indonesian living in Indonesia, I think the perception of risk for the Indonesian sovereign is far lower than the perception of risk.
That's actually the future of wealth creation, is looking indigenously now and saying that, hang on, I'm missed out on the growth story right behind me or right around me.
Exactly. So I think there's a lot of wealth coming home as a result, and a lot of wealth investing in domestic markets where they see a clearer picture, shall I say, going forward than what is likely to happen in Europe or even the US.
Debashish, thank you very much indeed for joining us. Debashish Duttagupta there from Citi.